Welcome to this in-depth exploration of Quantify Fund's BTGD ETF, a groundbreaking investment vehicle that combines 100% exposure to Bitcoin and 100% exposure to gold in a single, actively managed ETF. Designed to complement a traditional 3 ETF portfolio, typically comprising a broad market index, a dividend-focused fund, and a growth-oriented ETF, BTGD offers a unique blend of high growth potential and diversification. In this guide, we'll delve into the methodology, performance, benefits, and risks of BTGD, exploring why it's an ideal addition for long-term investors seeking to enhance their portfolios. We'll also discuss the case for Bitcoin and gold, their roles as scarcity-driven assets, and how BTGD addresses the challenges of traditional leveraged ETFs through innovative rebalancing. Please note that this presentation is for entertainment purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. The 3 ETF portfolio is a cornerstone of long-term investing, balancing stability, income, and growth. Typically, it includes a broad market ETF like the SPDR S&P 500 ETF, SPY, which tracks the S&P 500 and delivers average annual returns of 7 to 10%. A dividend ETF like the iShares Core Dividend Growth ETF, DGRO, offering steady income with a yield of around 2 to 3%, and a growth ETF like the Vanguard Growth ETF, VUG, focusing on high-growth companies with potential for capital appreciation. This structure provides diversification across market sectors, income stability, and exposure to high-growth opportunities, making it a robust strategy for building wealth over decades. However, even a well-constructed 3 ETF portfolio can benefit from additional diversification, particularly in today's economic environment characterized by persistent deficits, rising debt, and monetary expansion. Traditional assets like stocks and bonds may not fully address the risks of currency debasement or market volatility. This is where Quantify Fund's BTGD ETF comes in, offering a unique solution by combining 2 scarcity-driven assets, Bitcoin and gold, into a single fund that enhances both growth and diversification without sacrificing the core principles of a 3 ETF portfolio. BTGD, launched by Quantify Funds, is the first ETF to provide 100% exposure to both Bitcoin and gold within a single investment vehicle. Unlike traditional leveraged ETFs, which often carry warnings about being suitable only for daily trading due to decay from frequent rebalancing, BTGD is designed for long-term holding. Its investment objective is straightforward. For every dollar invested, you gain 100% exposure to Bitcoin and 100% exposure to gold, effectively acting as a 2x basket of a 50/50ths portfolio between these 2 assets. This is achieved through futures contracts which provide leverage at a cost equivalent to the Treasury bill rate, under 5%, making it a cost-effective alternative to margin borrowing, which often exceeds 5% in interest. The fund's active management ensures that exposure remains balanced by rebalancing when the allocation between Bitcoin and gold drifts by approximately 5%. This disciplined approach mitigates the decay common in leveraged ETFs, where daily rebalancing can erode returns in volatile markets. BTGD's low correlation between Bitcoin and gold, historically around 4% over the past decade, enhances its diversification benefits, as one asset's decline is often offset by the other's stability or growth. For example, during a recent market pullback, BTGD remained positive due to gold's outperformance, demonstrating its ability to buffer volatility. Since its inception, BTGD has delivered exceptional performance, with returns in the low 90% range, outpacing both Bitcoin, up 70%, and gold, up 20%. This outperformance stems from the compounding effect of holding 2 high-performing assets with low correlation, minus the modest cost of leverage. For instance, a $10,000 investment in BTGD would have grown to approximately $19,000, compared to $17,000 for a Bitcoin-only ETF like IBIT or $12,000 for a gold ETF like GLDM. This makes BTGD a compelling addition to a 3 ETF portfolio, offering both growth and diversification. To understand BTGD's value, we must first examine the investment case for its underlying assets, Bitcoin and gold. Both are scarcity-driven assets, meaning their supply is constrained, making them effective hedges against currency debasement caused by excessive money printing. Bitcoin, with a mining rate of 0.86% per year, post its 2024 halving, has a strictly limited supply, with only 21 million coins ever to be created. This scarcity, combined with growing institutional adoption, evidenced by ETFs and corporate treasuries like MicroStrategy holding significant Bitcoin, has driven its price to top 10 global asset status. Over the past decade, Bitcoin has delivered annualized returns of over 50%, though with significant volatility, including drawdowns of up to 70%. Gold, mined at a rate of 1.75% annually, is a time-tested store of value, particularly during periods of economic uncertainty. Since the US abandoned the gold standard in 1971, gold has transitioned from a stable-priced asset to one with positive real returns, averaging 4 to 5% annually above inflation. Central banks, holding 1/3 of annual gold production, continue to bolster demand, especially as alternatives to US dollar-denominated debt. Gold's low correlation with equities, particularly post-2020, when bonds lost their diversification benefits, makes it a critical defensive asset. The low correlation between Bitcoin and gold, 4%, is a key driver of BTGD's success. During Bitcoin's 15% drawdowns, gold has historically remained flat or risen, providing a buffer. For example, in April 2025, when equities, bonds, and the dollar fell simultaneously, a phenomenon typically seen in emerging market economies, gold held steady, while Bitcoin's volatility was offset by BTGD's rebalancing. This dynamic allows BTGD to capture upside potential from both assets while mitigating downside risk, making it an ideal complement to a 3 ETF portfolio. Incorporating BTGD into a 3 ETF portfolio offers several advantages. First, it provides exposure to alternative assets with high growth potential and scarcity characteristics, enhancing overall portfolio returns. With Bitcoin up 70% and gold up 20% in the past year, BTGD's 90% return demonstrates its ability to outperform traditional ETFs like SPY, 7 to 10%, or VIAGI, 15 to 20%. For a $100,000 portfolio allocated 80% to SPY, DGRO, and VUG, adding 5%, $5,000 to BTGD could boost annual returns by 4 to 5%, assuming historical performance persists. Second, BTGD enhances diversification. The low correlation between Bitcoin and gold, and their collective low correlation with equities, reduces portfolio volatility. For instance, during a recent market tantrum driven by tariff concerns, BTGD's positive performance contrasted with the S&P 500's decline, showcasing its defensive qualities. This diversification is particularly valuable in today's environment, where deficits and debt levels are pushing investors toward hard assets. Third, BTGD's active management eliminates the need for investors to manually rebalance Bitcoin and gold holdings. Without BTGD, an investor seeking 5% exposure to each would need to allocate 10% of their portfolio, requiring constant monitoring and trading. For example, if Bitcoin surges to $108,000 and gold declines, an investor would need to sell Bitcoin and buy gold to maintain balance, a complex task for retail investors. BTGD handles this rebalancing, ensuring consistent 100% exposure to both assets, saving time and reducing stress. Finally, BTGD's leverage is cost-effective and designed for long-term holding. Unlike traditional leveraged ETFs, which suffer from decay due to daily rebalancing, BTGD's 5% drift rebalancing minimizes erosion. Its financing cost, tied to the T-bill rate, under 5%, is lower than typical margin rates, making it an efficient way to amplify returns. For example, a $10,000 investment in BTGD provides $20,000 of exposure, $10,000 Bitcoin, $10,000 gold, compared to $10,000 total exposure if holding IBIT and GLDM separately. While BTGD offers significant benefits, it is not without risks. Its annualized standard deviation of 51.99% since inception, compared to 47.41% for IBIT and 18.6% for GLDM, indicates higher volatility than standalone Bitcoin or gold ETFs. This volatility, driven by Bitcoin's price swings, means BTGD can experience drawdowns, particularly during crypto-specific crises. For instance, a 15% Bitcoin drop could lead to a 7 to 8% decline in BTGD, though gold's stability often mitigates this. The use of leverage, while cost-effective, amplifies both gains and losses. During a broad market pullback, BTGD's beta from Bitcoin could result in larger drawdowns than the S&P 500, though gold's defensive nature provides a buffer. Investors must assess their risk tolerance, as BTGD is suited for aggressive or growth-oriented investors comfortable with volatility. Another consideration is the novelty of combining Bitcoin and gold. Some investors, particularly Bitcoin purists or gold advocates, may resist the idea, preferring to hold these assets separately. However, this overlooks BTGD's diversification benefits as evidenced by its sharp ratio of 1.76, one of the highest among ETFs since the 2024 election. Misunderstandings about BTGD's leverage structure may also deter investors, who may mistakenly view it as a short-term trading vehicle rather than a long-term holding. To integrate BTGD into a 3 ETF portfolio, investors should consider a modest allocation to balance risk and reward. Financial experts, including Ray Dalio, recommend 5 to 10% in gold and 1 to 5% in Bitcoin for diversified portfolios. BTGD simplifies this by allowing a single allocation to achieve both exposures. For a $100,000 portfolio, allocating 5%, $5,000 to BTGD provides approximately $5,000 exposure to each asset, leaving 95% for SPY, DGRO, and VUG. This maintains equity-heavy exposure while adding diversification. Dollar cost averaging is the preferred method for investing in BTGD due to its volatility. For example, an investor could allocate $5,000 over 8 weeks, investing $625 weekly to smooth out price fluctuations. This approach is particularly effective given Bitcoin's history of 50 to 70% drawdowns and gold's periodic sideways trends. By spreading investments, investors can mitigate the risk of entering at a peak, such as Bitcoin's $108,000 high in December 2024. In a rising equity market, BTGD is likely to outperform due to Bitcoin's correlation with money supply growth, which often exceeds equity gains. For instance, if the money supply grows at 7 to 9% annually, Bitcoin could rise 20 to 30%, boosting BTGD's returns. In a bear market, gold's defensive properties help limit drawdowns, as seen during a recent pullback when BTGD remained positive while the S&P 500 declined. However, investors should be prepared for volatility, as BTGD's 50% standard deviation means potential 10 to 15% swings in turbulent markets. Consider a 35-year-old investor with a $200,000 portfolio aiming for long-term growth and modest income. A sample allocation might be 50%, $100,000, in SPY for broad market exposure, 7 to 10% annual return, 30%, $60,000, in VUG for growth, 12 to 15% annual return, 15%, $30,000, in DGRO for dividends, 2 to 3% yield, 5 to 7% total return, 5%, $10,000 in BTGD for alternative exposure, 90% historical return, 50% volatility. This portfolio balances stability, growth, and income while adding BTGD's high growth potential. The $10,000 in BTGD could generate $9,000 annually in unrealized gains, based on historical performance, enhancing total returns. During a market downturn, BTGD's gold exposure would mitigate losses, while its rebalancing ensures consistent exposure to both assets. For a retiree with a $500,000 portfolio prioritizing income, the allocation might shift: 40%, $200,000 in SPY for stability, 30%, $150,000 in DGRO for higher dividend yield, 20%, $100,000 in VUG for moderate growth, 10%, $50,000 in BTGD for diversification and growth. Here, BTGD's $50,000 allocation could add $45,000 in annual gains, supplementing dividend income from DGRO while diversifying away from equities. Dollar cost averaging over 12 months would reduce entry risk, ensuring the retiree captures BTGD's long-term potential. Quantify Funds, founded by David Jacansky, brings institutional quality leverage tools to retail investors. With 20 years of ETF management experience and 13 years in product development, Jacansky's background includes managing $1.8 billion in ETF portfolios at Ladenburg Thalmann and collaborating with Tuttle Financial Group. Quantify Funds' focus on innovative, scarcity-driven assets sets it apart from larger issuers like BlackRock, which often prioritize broad-market ETFs. BTGD's unique structure, combining Bitcoin and gold with active rebalancing, addresses the limitations of traditional leveraged ETFs, making it a powerful tool for long-term investors. Unlike other ETF issuers, Quantify Funds targets assets with inherent supply constraints, reflecting the economic realities of persistent money printing and deficits. BTGD's success, with $52 million in assets under management 9 months after launch, underscores its appeal. Its Sharpe ratio of 1.76, driven by low downside beta during volatile periods like the 2024 tariff tantrum, highlights its efficiency. By contrast, standalone Bitcoin ETFs, Sharpe ratio approximately 1.2, and gold ETFs, approximately 0.8, offer lower risk-adjusted returns. One common misconception about BTGD is that it's a short-term trading vehicle due to its leverage structure. In reality, its active management and long-term design make it suitable for buy-and-hold strategies, as stated in its prospectus, which omits the daily use disclaimer common in leveraged ETFs. Another mistake is the reluctance of Bitcoin and gold purists to embrace a combined ETF, overlooking the diversification benefits. For example, Bitcoin bulls may hold 10% of their portfolio in IBIT, missing gold's defensive qualities, while gold investors may avoid Bitcoin's growth potential. BTGD bridges this gap, offering both in a single fund. Investors also err by over-allocating to volatile assets without diversification. A portfolio with 20% Bitcoin and no gold or equities risks severe drawdowns, as Bitcoin's 70% corrections are not uncommon. BTGD mitigates this by balancing Bitcoin's volatility with gold stability, reducing overall portfolio risk. Finally, failing to dollar-cost average into BTGD can lead to poor entry timing, given its 50% volatility. Spreading investments over time ensures a more stable cost basis. Looking ahead, the case for Bitcoin and gold remains strong due to ongoing fiscal challenges. With global debt levels rising and money supply growing at 7 to 9% annually, scarcity-driven assets are likely to outperform. Bitcoin's institutional adoption, evidenced by ETFs and corporate treasuries, suggests continued growth, potentially reaching $150,000, $200,000 within 5 years, though with 50 to 70% drawdowns possible. Gold, supported by central bank buying and its role as a safe haven asset, is expected to maintain steady growth, potentially reaching $3,000 per ounce by 2030. BTGD's ability to capture these trends while mitigating volatility makes it a forward-looking addition to a 3 ETF portfolio. In a rising equity market, BTGD's Bitcoin exposure could drive 20 to 30% annual returns, while gold buffers downturns in bear markets. For example, during a hypothetical 15% equity correction, BTGD's gold component could limit losses to 5 to 7%, compared to Bitcoin's 10 to 15% drop. Quantify Funds BTGD ETF is a game-changer for investors seeking to enhance their 3 ETF portfolios. By combining 100% exposure to Bitcoin and gold, BTGD offers high growth potential, diversification, and cost-effective leverage, with a historical return of 90% and a Sharpe ratio of 1.76. Its active management and low correlation between assets make it a unique tool for long-term investors, addressing the challenges of currency debasement and market volatility. Allocating 5 to 10% of a portfolio to BTGD, alongside SPY, DGRO, and VUG, balances risk and reward, while dollar-cost averaging ensures prudent entry. For those eager to learn more, visit quantifyfunds.com to access research papers, including the case for Bitcoin and gold, and sign up for their contact list. Quantify Funds' innovative approach, led by David Jacansky's 20 years of expertise, positions BTGD as a standout in the ETF landscape. Stay diversified, stay informed, and consider BTGD as a powerful addition to your long-term investment strategy. Thank you for joining this comprehensive guide to BTGD. Keep learning, keep investing, and take control of your financial future.